This region around the Great Lakes has been called the heartland when it comes to agriculture. There's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
There's a lot of self-proclaimed geniuses out there that know the national yield, but they're all wrong.
Manage money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
That's what brings the viewers back. That a boy.
Good morning, everybody. It's Tuesday, June 2nd, and this is the AgYield War Room. Dan Dempsey will be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area. I'll be sure to get to it during the show. Overnight markets here, July corn down a penny and a quarter at 442 3/4. July soybeans around 3.5 at 1177 1/4. And July Chicago wheat was down 5 3/4 at 603. No export sales announcements here this morning, so we'll jump right in. Yesterday afternoon, we got weekly crop progress in our first conditions report. Corn is 93% planted. That was up 7% from last week and just a little bit above the 5-year average there of 92%. 67% rated in the good to excellent category, which was down 2% from the initial rating last year of 69% there. So on the soybean side, 87% planted. That was up 8% from the previous week and 7% above the 5-year average there. And pretty similar to corn, 66% in the good to excellent category, down 1% from the first reading last year. On the spring wheat side, 47% rated good to excellent. That's down 3% from the previous year. And winter wheat held steady, 26% in the good to excellent category. So unchanged from last week and still sharply below last year's reading of 52%. Good morning, fellas. We'll jump right in here. I mean, not a whole lot of fresh news, if you will. We did get, as I said, I think people are talking about the conditions report. It's everybody's favorite time of year. We argue about crop conditions every season, it feels like. Weather looks good, non-threatening pretty much here for the next week or so, 10 days. We are still waiting to figure out what's going to happen with this 60-day extension on the ceasefire deal. Nothing out of Washington yet. So Dustin, maybe share a few thoughts here as we kick off the morning, and then we'll throw around the room.
Yeah, thanks, Dan. Yeah, I think, as we saw yesterday, it was the old crop contracts were really starting to collapse against new crop contracts, mainly corn, soybeans. So fresh lows reached in both of those. So July D's corn, for example, traded all the way down to 29 1/4 cent carry. And we've talked about this, like that's just shy of a 60% of full carry. I think in this, it's just a narrative that, kind of created in my head here, but like, I think it's clear that the crop's growing and we're starting to see more old crop move as a result, right? We're getting post-planting. There's more time to think about it. We're getting back into that delivery time frame. And we're seeing old crop beans fall to the lowest that they've been to new crop. And the same with old crop corn. 2+ billion bushel carryout. We know that at some point demand's probably going to be met, for the summer. And just hearing more and more just negative rhetoric from buyers, especially in the East, about basis starting to fall. Now I still have seen some pretty good bids out through June, July in parts of the East. So it's not. I don't know how much of that is projection and how much of it is really, but there's a lot of bushels in the countryside still. We know that in the North and the West, that's where most of the excess supply has been, and that can still make its way into the river system. And to see carry rates where they are, I think that all makes sense. The question is, where does flat price go? Because we still do need to grow a crop. Are we going to go back to, sub-insurance levels for corn before we actually get that pollination forecast with, energy prices still where they're at? I mean, I think for me to expect, let's say a 450 corn price pre-pollination, I think it's got to be that we continue or move towards some sort of an agreement with Iran. Energy prices are settling down. That's still very volatile. So as we're getting down these lower price points, I think, again, we've been talking about hedging a lot when we were, at higher price points, especially getting rid of old crop, starting to take at least some minimal steps for plan A and plan B for new crop. But I think these are some opportunities pre-pollination to get that balance back in, because I listed it in the letter last night. We've got crop insurance. We've got the strongest farm bill basically in my career, right? That we can lean on for some sort of price support. And I would argue that there's some sort of third unknown payment coming because of high fertilizer prices, which they've talked about, a lot. We've had ECAP bridge payment last 2 years, right? $30 to $40 an acre. I would not be surprised to see a similar type of payment this year to compensate for higher fertilizer prices. And that is most likely going to happen if prices are lower. If we get into a big bull market and farmers are making a ton of money, I think it's less likely to happen. So these are the balances that I think we need to kind of keep thinking about and keep trying to plug in some estimates of what could happen and just try to fine tune like where your risk is at, because, getting really panicky and selling into a low if you haven't done much yet may not necessarily be the best idea. There might be softer ways to still hedge.
Ben, what's on your mind this morning?
Yeah, I think that longs and old crop have got some decisions to make here in the next 20 days or so. And with weather being perfect, you can make a case that we roll over and push into the low 30s and try the previous July contract lows, I guess. Looking at it from a trader's perspective, I don't think I would want to, and kind of to Dustin's point, I don't think I would want to initiate a short position here. I think there will be some volatility and some bounces still. There's a lot of things in the backdrop, but it's going to be, I think rallies are kind of meant to be sold until otherwise. So just sort of ambivalent. I think we've done a lot of what we've needed to do. We held long-term trend line that came in at 40. We are still holding above the 200-day moving average in D's. I kind of suspect that may give way at some point, but I think there's enough below the market demand, the different insurance packages that are out there, that I don't think that we're going to sniff the lows that we saw last year, especially with a projected year-over-year decline in stocks, which is still plentiful. And then you've got to look at the acreage report, and there's some pretty strong opinions on that. So, I don't think we have much here to work with for the time being.
Well, you got a big fund position. What if the funds flip?
It's possible, a lot of that trade is automated. It's algorithmic, and they could get short and pile into this thing and drive it lower. I think that their issue is going to be getting out of it eventually, because I think corn demand, we've talked about this going back 7 weeks, 8 weeks, that a lot of the things that are going on are probably more fall issues than today issues. And, they're already projecting quite a bit lower output out of Australia due to fertilizer and fuel costs. And that's the third largest wheat exporting nation. So I think these things come later. So they could get short, right? They could hammer this thing down into, the end of August, like we typically see kind of a seasonal bottom. But I think there's a lot of risk associated with that, especially with what's going on in the Straits. If crude goes to, some people and some analysts are, the head of Chevron are talking $150 barrel crude. I don't know, but it's going to be really hard to keep grains down if that happens.
Sure.
So
Justin, what's on your mind?
Oh,
sorry, Ben.
I just say we hear seasonal, but there's nothing externally that is seasonal about what's going on, I guess is where I'm getting.
Justin, what's your thoughts?
Yeah, I mean, kind of broken record here. I think month of June's just gonna be a tough long, especially with where we're sitting now. Obviously, to these guys' point, we could turn really negative on Iran again, and we just hit a tipping point where the market can't stand it anymore. The market's been good at shrugging off risk, I think, in the energy markets and grains to some extent. So, you have seen, crude oil inventories in several countries get to, multi-decade lows. So we're chewing through a lot of reserves, anticipating this to, open up and free up supplies. I think there's obviously been damage, and it's going to take some time to get anywhere near where we were war with Iran. So, you never know. To Ben's point, it's volatile. So, and these guys move super fast. So it wouldn't surprise me to see, farmers dump a bunch of old crop corn, just because, they have to. Crop looks good, everybody gets really bearish, and it flips on a dime. I just think we're in that kind of environment where you can feel really smart one day and really dumb the next day, as a trader. So, yeah, I think, kind of what we've been trying to preach the whole time is just, really leaning on the matrix and where all those things come in, because, there's guys that did a lot of good hedging on top of now, getting into where lifting hedging starts to make sense because they're getting triple paid. And those kind of things can be the difference between a really successful year and a not so good year, is just being really disciplined on when to add hedges and when to take some off and have that right balance. So not an exciting market opinion here, but I'm kind of it's going to be tough to have big rallies or just to hold big rallies right now, until first notice day, unless something major changes. So
very good. Ryland, let's move quickly here over to livestock. Cattle had a strong start to the week, and new lows pretty much across the hog complex there. So I want you to share a few thoughts as we start the morning.
Yeah, not too much to go on this morning here. I mean, you had the mild recovery yesterday in prices on the cattle side of things. I mean, I think everybody's a little bit cautious here, just with cash prices just kind of falling for the past couple weeks here, with 256, 257 cash last week, and just kind of the trajectory in beef just being a little bit more on the flat side. Seems like packers may try to take a little bit of advantage of the situation. Not saying that it has to be lower, but just that we may see some low ball bids start to roll out here. So just keeping an eye on that. I mean, I think overall, obviously supply is still tight here. Market's kind of trying to hold up pretty well, but we got the big discount already kind of baked into the board, so the market's definitely expecting this, I think, to happen. So we'll see if it does. And on the hog side of things, open interest, big jump here, up 32.25 contracts and commitments. So, we did see new lows in August. Akendis, you would hope that maybe somebody's trying to fade this kind of price action, but still just not seeing any real support here that the market wants to see in carcass. We're only up 30 cents yesterday. Cash was up a little bit, so you got a little bit of maybe a little bit more positive leaning fundamentals. And I mean, this is definitely a good seasonal time frame from a demand standpoint. Just seems we've just taken a lot of wind out of the sail in futures here. So we'll see if we can get that nice little seasonal bump in carcass, but as of right now, it just has not happened yet. There's been nothing inspiring from the buy side of the market here.
Very good. Appreciate the update there, Rye. A couple things to point out here real quick. Link has been in the description. We talk about it every day, but check out the War Room Report. It's access to premium content, reactions to USDA reports, and just really an overall deeper dive into the things we talk about every morning here on the War Room. So be sure to check that out. Also, a portion of those subscription fees go directly to support the AgYield NextGen Foundation, which of course puts on our national scholarship competition. So we've got 5 very deserving winners that were awarded a couple weeks ago. We'll be honoring them here later in July at our golf outing. So really looking forward to that. So give us a call if you got any questions about that, how to support that. We'd love to visit with you there. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. We're doing this every day that the markets are open on X, Facebook Live, and YouTube Live at 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we'll talk to you again tomorrow.
The War Room is presented by AgYield, a risk management partner of American grain farmers for over 50 years. Looking for more in-depth analysis? Check out the War Room Report. Our team's knowledge and expertise delivered straight to your inbox every weekday. Each report delivers key market-moving headlines, critical weather updates, USDA report breakdowns, and exclusive video content. all for $50 a month. And most importantly, 10% of every subscription will go directly to support the AgYield NextGen Foundation, a nonprofit investing in agricultural education and the future of farming. To sign up for the War Room Report, check out the link in the description or learn more at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.